So let's start reading the question and do it one by one. Just a second. Okay, so coming back to the question, we are live on YouTube as well. So Peter, Paul, and Prince were partners sharing profit and losses in the ratio of 2:1:1. Okay, so it was provided. Guys, please mute yourself. It was provided in the partnership deed that in the event of retirement death of a partner, he or his legal representatives would be paid the following: balance in the capital account. Okay, even if they don't mention this, we know that it has to be given. His share of goodwill in the firm, valued at 2 years purchase of normal average profits after charging interest on fixed capital. So we'll have to calculate the normal average profits after charging interest on capital, and that average has to be done for 3 years to 31st December preceding the retirement or death. So say for example, if the partner dies in the current year 2022, you have to consider till 31st December of 2021. Okay. His share of profits from the beginning of the accounting year to the date of retirement or death, which shall be taken on proportionate basis of profits of the previous year, has increased by 25%. Now, a simple statement: whatever is the previous year's profit, you will increase that by 25%, and proportionate share, and also on the basis of time, you will consider the share in profit. Interest on fixed capital of 10% per annum payable to the partners will not be payable in the year of death or retirement. Again, in this part, you will not give interest. You will not give interest in the year of death. All the assets are to be revalued on the date of retirement or death, and the profit and loss to be debited or credited to the capital accounts in PSR. So this is also an extra information. Anyways, this is known. Now, Peter died on 30th September. So one good thing for exams is everybody dies or retires on the first day of the month or the last day of the month. So no complications in number of days. Books of accounts are closed on calendar year basis. So financial year is from 1st of January to 31st of December. Balance in the fixed capital accounts as on 1st January where Peter 10,000, Paul 5,000, and Prince 5,000. Okay, so these are the fixed capitals. Balance in current account 20,000, 10, and 7. What will we do with the current account?
After adjustment, we transfer it to capital accounts.
Yes, after adjustments, we'll transfer that to capital account. Okay. Then drawing of Peter till 30th of September were 10,000. What will we do with this? Drawings of Peter?
Sir, if interest was to be provided, we'll.
So the question has not mentioned anything about interest, so we'll not provide any interest. Okay. Then in that case, what will we do with these drawings?
So we'll reduce it from capital.
Yeah, so we'll debit it to the current account and or transfer it to the capital account. The profit of the firm before charging interest on capital for calendar year 16, 17, and 18 were 1 lakh, 1 lakh 20, and 1 lakh 50 respectively. So that is the amount of profit before charging interest on capital. Okay. The profits include the following abnormal items of credit. So profit on sale of assets 5,000, insurance claim received 3,000, 7,000, 10, and 12. Now, whenever we are valuing goodwill, we will value goodwill using the normal profits and not the abnormal profits. So we'll make adjustments for this. Then the firm has taken a joint life policy of 1 lakh. Besides, the partners had severally insured their lives for 50,000 each. Now, when we say that the partners have severally insured their lives for 50,000 each, means on each partner's life, there is an insurance of 50,000 and there is an overall joint life policy of 1 lakh. Then the premium was charged to P&L. Now, if premium is charged to P&L, and here we said Peter died on 30th of September, how much amount will we receive from joint life policy?
So the total amount to be received would be for the joint life policy account, the total policy value, so 1 lakh.
1 lakh will be received. Very good. Then what about the separate life policy?
Sir, for that, partners who have died, the policy value will be received, and the existing partners, the surrender value will be received.
Very good. So for one partner who has died, we will receive 50,000, and then it says surrender value of policy were 30% of the face value. So for remaining two, 30% of 50,000, that is 15,000 each. Okay, right? Then on June 30th, 2019, the firm received notice from the insurance company that the insurance premium in respect of fire policy had been undercharged to the extent of 6,000 in the year of 2018, and the firm has to pay immediately. Now, where all will this have an impact when we come to this settlement? The question says in 2018 we had to pay 6,000, which we did not pay. Correct?
Yes.
Now, what will be the impact of this?
So the profits of 2018 has to be reduced to this extent of 6,000.
Profits of 2018 has to be reduced to the extent of 6,000. Okay, then
So that the effect should be given to the capital accounts of all the partners.
why should we give the effect to the capital account of the partners?
Revaluation account, there'll be a
So because there is an unrecorded liability. So this adjustment has two impacts. One, you will have to adjust it while calculating goodwill. And second, because there is an unrecorded liability, or we have to pay a fresh, some amount to the insurance company, this 6,000 represents a revaluation loss. Correct? Yes or no?
Yes, sir.
Okay. Then the revaluation of the asset indicate an upward revision in the value of asset to the extent of 20,000. Prepare an account showing the amount due to Peter's legal representatives as of 30th September. Okay. So other than a lot of calculations, and because it is given in a text format, this question is not very complicated. As we take up each adjustment, we'll be able to understand that. And anything specific here, you say assets to be revalued on the date of retirement and profit and loss to be debited and credited to the capital accounts in the profit sharing ratio. So here we'll credit it to capital accounts, will not credit it to current accounts. Okay, you can credit it to current accounts if this was not there, but otherwise you'll have to do that. Now here, if we have to prepare the amount due to the firm, here if you have to prepare the amount due to the partner, not to the firm, we need goodwill. We need to do a revaluation. Okay, then we need to prepare the partner's capital account, current account, joint life policy. Right? These are the things. Yes or no?
Sir, what is joint life policy?
Sorry?
What is joint life policy?
Joint life policy is a policy taken on the lives of the partner. If you have missed our previous session, we had covered, or a session prior to that maybe, we had covered joint life policy in detail. Okay. So
Okay, sir.
here first thing we'll prepare is the goodwill part. Calculation of goodwill. Now, what does the question say? The question says take profit before interest, charge interest on fixed capital, and we have to do adjustments for abnormal item. And there was one item of insurance which was not considered, that we have to consider. So he died in 19, so 2017, 2018, and 2019. Profit as per P&L before interest. What is the profit as per P&L before interest? Let's come back and see. Yeah. It says 1 lakh, 120, and 150. So 1 lakh, 120, 150. Okay, then less interest on capital at 10%. Correct? 10% is what they said. Fixed capital is 10%. So Peter, Paul, and Prince, 10,000 plus 5, 15 plus 5, 20,000. If you do, how much is the interest at 10%? 2,000. Correct? 2,000, 2,000, 2,000. Then there are some adjustments to be done. Now, tell me one thing. When we have profit and sale of asset which has been credited to P&L, while calculating goodwill, what will be the adjustment be? Will we add or will we deduct?
Deduct.
Why will we deduct? Why will we deduct it?
So because the value of asset, the money received has been added to the P&L account, sir.
Correct. So because it has been added, now we will reduce it. If it was reduced, we will add it. Okay. Just a second. So because it was added, now we will reduce. And see, the reason why I'm asking this simple question again and again is so that it is reinforced in the examination. The moment you see this adjustment, it should come to your mind that yes, we have to reduce it. So 5, 7, and 10, 3, 0, and 12. Minus 5,000, minus 7,000, minus 10,000. And then we have 3, 0, and 12. Correct. Then there was an expense which was not charged. Now we have to charge it. And which year was that? That was in the year 2018. So, sorry, this is 2016. This is 2016, this is 2017, and this is 2018. And here there is an insurance expense not charged. That is 6,000. Okay. With this, we'll get the adjusted profit. N minus 10, 90,000. 111 and 1,20,000. Any doubt so far?
No, sir.
No doubt. Okay, thanks. Then average. Now see here, you can do a weighted average. Did the question tell anything? The question mentioned what? How do we do the goodwill here? 2-year purchase of normal average profit. So we'll just take a simple average profit. Average profits is equal to sum of these three divided by 3. You get 1,07,000. Okay. Now years of purchase 2. Goodwill 1,07,000 multiplied by 2, which is 2,14,000. How much is Peter's share? 2,14,000 multiplied by, what is the ratio? 2:1:1. So 2/4. which is 1,07,000. Now, friends, in this question, the question has only asked us to prepare Peter's account, their related account to Peter. So need not worry about what is the share of the remaining two partners. Okay, so this calculation or this much of calculation is more than sufficient, right? Then once we are done with the goodwill calculation, we can start preparing the partners account. So let us do that. Peter's capital account and Peter's current account. So here capital account of Peter is 10,000 and current account of Peter is 20,000. So by balance 10,000, by balance 20,000, right? Then is there any other balance given here which has to be transferred? Nothing has been mentioned here. So we will go one by one. We have to give the treatment of goodwill. Goodwill Peter's shares is 1,07,000. So by what are the other two partners? Paul and Prince. By Paul and Prince, it is 1,07,000. This number. Okay, you can distribute between Paul and Prince in their existing ratio. That also you can pass the entry, not a problem. So goodwill credit has been given. Interest, will we provide interest on capital for this year?
No, sir, because the question said it's not payable on the year of death.
The question said because it is not payable on year of retirement, we will not be providing any interest. Correct? So that interest will not be provided. We need to provide share of profit. Now, how do we calculate share of profit? We have to take previous year's profit, correct that for the insurance amount, and on that increases 25%. So profit for 2018 was how much? 1,50,000 less insurance expense 6,000. So correct profit 150 minus 6, 144. Add 25%. So this multiplied by 25%, 36. So the total comes to 1,80,000. So estimated profit. And when did he die? He died in September. So how many months of profit is he entitled to?
9 months.
How many months of profit is he entitled to? 9 months, right? Because January to December is the calendar year. So he is entitled to a profit share of 9 months. So profits for 9 months is 180 divided by 12 multiplied by 9. You get 135. Here is half. So, guys, please mute yourself. Share is half, so 67,500. But this profit is before interest. I think we excluded interest. No, interest was also given in the previous period. So we'll have to provide for interest. See, we will not provide for interest on Peter's capital, but for other two partners, will we provide interest or not?
Yes, sir.
So less interest on capital for remaining partners. So for all the partners, it was 2,000. For the remaining two partners, it will be 1,000 because their capital is half. The capital is 5,000 and 5,000. So interest will be 1,000 for the full year. So adjusted profit will be 180 minus 1,000. That is 179. Profit for 9 months is 179 divided by 12 multiplied by 9. And his share is half, which is 67,125. Now this share of profit will be credited to current account. 67 125. Then
Sir,
yes,
why are we match the 25%? No, sir, we are making it 125%. So that why don't we do after
sorry, can you be a
giving
bit
interest?
louder? Can you be a bit louder?
Sir, we are after adjusting the profit, we are taking 25% increase, and then we are reducing interest on capital now, sir.
Correct.
But
Correct.
sir, but shouldn't we first also adjust for the interest on capital and then increase by 25%, sir?
See, profit is profit from the business. Okay. Interest is fixed. Interest amount is not changing. Last year also you paid the same rate of interest. This year also you are paying the same rate of interest. Your profit, what you are talking about, is profit from your normal operations from the business. Interest is an item of P&L appropriation.
Yes, sir. Yes.
Okay. So if you
Yes.
see the question, what does the question say? Proportionate basis of profits of the previous year. So we are talking about what is the profit that the business has earned. Based on that, what will be the increase in 25%? And of course, we have to pay interest to the other partners. On that basis, we have taken proportionate profits for 9 months. Okay.
Yes, sir.
Right. So this is done. Profit is done. Then revaluation. Then revaluation. Revaluation, it says assets to be revalued and the profit and loss to be debited or credited to the capital accounts. Now, revaluation profit is 20,000 here. So, in his capital account, you have by revaluation, half of that will be 10,000. Then there is an unrecorded expense which you would be taking to your revaluation account, that will be debited. So, to revaluation, or you can say to cash or bank, either ways is fine. Amount was 6,000, of that half is payable. So of that half is pertaining to Peter. So 3,000 will be debited there. Okay. Now, after this, we are left with one more important adjustment, that is joint life policy. Now, joint life policy, sum assured is 1 lakh. Amount received will be 1 lakh. And again, this will be a good revision for those of you who had not, who had forgotten, or who had not revised enough in the previous class. Do we have any joint life policy as asset in the balance sheet?
No, sir.
Do we have any joint life policy as asset in the balance sheet?
No, sir.
We don't have, which means entire 1 lakh is a gain which has to be credited to partner's account. So Peter's share is 1 lakh divided by 2, 50,000 from here. Then separate policy, Peter and other two partners. I don't remember the name, Paul and Prince maybe. Sum assured 50,000. Here you will receive entire 50,000. Here you will receive only 50%. No, sorry, 30%.
30%.
And here also you will receive 30%. Peter share will be this divided by 2, divided by 2, divided by 2. The total of this is 90,000. So insurance premium or insurance claim by insurance proceeds 90,000. Then I think they are given drawings also, if I recall it right. Drawings of Peter were 10,000. So 2 drawings, 10,000. Okay. Now whatever is the balance will be transferred to the capital account. So to capital account. Now you can do the total here. Minus 10 minus 3. So 271125 which transferred to capital account. Let us see if we did it rightly or not. 271125. So this is done correctly. Okay. So this will be transferred to capital, or you can directly transfer to executors. And even here, 10 and 10, 20 transfer to executors account. Right. Then you have to prepare the executors account. They have not prepared. Executors account from capital, from current to balance carried on. Simple question. Any doubt here?
No, sir.
Fatima, any doubt here? Fatima? No. Okay. Hope it's clear. Now, after this, as discussed in the previous class, we will move on to the next chapter, which is inventory. Inventory is important. One, obviously, you get mostly a 5-mark question generally in the examination. That is one thing. And this inventory chapter will be one of the basis or the fundamental which you will be using in your CA intermediate also. So there is a chapter called, insurance claim, loss of insurance claim, loss of goods of inventory, loss of inventory on that insurance claim. Then for that, you must know how to value inventory, how to recompute inventory. Then there could be questions on, accounting from incomplete records at CA Inter. Again, inventory chapter will be linked to that. You have a separate accounting standard 2 on inventory, from where again, generally a 5-mark question keeps on coming in the examination. So the foundation must be really strong. I'll not get into too much of detail of what is inventory, why inventory. I'll just give you a brief of that. We'll see the various methods, and we'll look at the most important part where students face difficulty, that is physical inventory and the books inventory, that movement between those two. That is what we'll be understanding in more detail, because that is where students get confused. FIFO, LIFO, weighted average. I don't think any of you would be facing a challenge. If you have any challenge in that, definitely let me know. I'll be happy to help you on that. More focus we would have on the other aspect where you want to move from the physical inventory to the inventory in the books. Okay. Now, when we talk about inventory, we generally have raw material, finished goods, and work in progress. Okay, generally raw material, finished goods, and work in progress. These three are called inventory. We have accounting standard. Which accounting standard covers inventory?
AS2, sir.
AS2. Okay, very important for you at CA Inter. Now also it's important. Then also it will be important when you come to AS2. Now, I'll ask a few questions, and based on that, I will take up the topics that I have to take. What is the fundamental principle of valuing inventory? What is the basis on which we value inventory?
Cost or net realizable value.
So inventories are valued at cost or net realizable value, whichever is less. Correct? This is a simple principle of valuing inventory. So on one side you have cost, and on the other side you have net realizable value. So you have cost, you have NRV. As far as cost is concerned, cost includes all the cost. Cost includes all the costs which are incurred to bring the inventory to the current location and condition. So for example, if I incur freight, so cost will include your purchase price, less discounts. Okay, then add transport, insurance, etc. Taxes and duties, if they are refundable, you will not consider. If they are non-refundable, you will consider. So add non-refundable taxes. What all will you exclude from cost of inventory?
Advertisement expenses, selling expenses.
Advertisement expenses, selling expenses, then sorry,
clearing charges.
Clearing charges, why will you exclude? Will include clearing charges, no?
No, like if it is clearing charges of seller.
Now, while selling, if they are incurring clearing charges, you will not consider. See the principle that you need to follow here, and the principle that you also need to follow when you are doing consignment. So let us say this is the business, okay, and this is the supplier, this is the customer, okay. Now all the cost from supplier till the time it reaches the business or the warehouse, you will include. Any cost incurred after the goods reach the warehouse, after that, whatever are the costs till the time you incur the cost to sell them to the customer, you will exclude. This simple principle will help you remember what are to be included, what are to be excluded. Recurring, non-recurring, this and that makes it really complicated. Most of the time, if you apply this simple principle, that cost incurred till the time the goods reach this particular warehouse of this business, all of that cost will be included. Your freight inwards, your transportation, your loading, okay, your unloading, all of that will be included. Anything after that will be excluded. Anything after that meaning warehouse rent, that is excluded. Or you are shipping to the customer, for that you are doing the packing, but you are using packing, that is excluded. Transportation outside, freight outwards, that is excluded. So all of these things will be excluded from the value of inventory. Okay, now we said there is on one side cost and there is on other side NRV. NRV is simply your selling price less estimated cost to sell and complete. So say for example, cost of purchase price is 1,000. Cash discount will not be deducted. Okay, trade discount is 100. Freight inwards is 200. Okay, then estimated selling price is 1,000. Sales commission is 5%. Okay, a very simple thing to quickly revise. Can you quickly compute and tell me what is the cost and what is the net realizable value, and at what value will you take the inventory? Okay, you have 2 minutes of time. Quickly do it and let me know.
Sir, the cost would be 1,200.
Yeah, sorry. Can you just repeat?
Is the cost 1,200 and the selling price 1,050?
Cost 1,200 and selling price
1,050.
1,050. Others, can you just type it out in the chat box so that we can I can remember what you have mentioned.
Yes.
Others, NRV 950, good. Cost 1,100, NRV 950, good. Cost 1,100. See, whenever we say cost, no, yeah, just now I mentioned purchase price less discounts, add transport, add non-refundable. So purchase price 1,000, less discount plus freight inwards 1100. So trade discount reduce, freight inwards add. Here, yes.
Sir, but when we record itself, wouldn't we account for trade discount and then record a price, sir?
No. So when I say purchase price, this is the list price. Okay. So if you look
Okay,
at the
sir.
standard, also the way they define is you have to consider the purchase price less discount. So if you assume that this purchase price is already after, see, so much of complication we will know that purchase price would have already included discount. So let me not take it again. That is also valid assumption. But generally, if you get a question like this in the exam, it is that the purchase price is without discount and there is a separate discount available. NRV is 1000 of selling price, 5% commission is 50. So your NRV becomes 1000 minus 50, 950, and you'll value inventory at 950. This is the fundamental principle quickly. Okay. Now, when it comes to cost, you have different methods. What are the various methods of valuing the inventory cost or arriving at the inventory cost?
Historic cost.
Cost is historic only, no?
LIFO, FIFO, weighted
P4, LIFO,
LIFO, weighted average,
weighted
simple
average.
Mm,
You can have simple average. You can have specific identification.
specific identity.
Correct?
Yes, sir.
Yes. Okay. LIFO is not allowed as per accounting standard. Others can be used. So FIFO is first in, first out. That is, there is an assumption that the material or the inventory that is purchased first is sold first. So what I'll do is I'll take a simple example. Let us say date 1st of January of 22, 7th of Jan of 22, 18th of Jan of 22, and 31st of Jan of 22. Okay. So no opening balance, purchases units, rate. Purchases 10 units, rate 100. Then on 7th January, there is a sale, 5 units. Selling rate doesn't matter. Okay, so I'll just put the selling price at 120, but doesn't matter for inventory valuation. Then again, there is a purchase of 20 units at 90. Then again, there is a sale of, let us say, 10 units at 120, for example. Okay. Now, when I say FIFO method, what I mean is, first of January, inwards, units, rate, amount. And please note, when you make entries in this, inventory register, this is like an inventory register. Whenever you make an entry in the inventory register, you will do it at cost. Selling price is not relevant. Okay. So 1st of January, there is a purchase. So there is inward of 10, rate of 100, and amount of 1000. Okay. Then on 7th of January, there is a outward of 5, and because we only have inward of 100, rate of 100, we'll consider outward rate as 100. Amount will be 5 into 100, 500. Here closing balance is nothing but your unit, opening balance, no opening balance, so purchases minus outwards 10. Amount will be 1000 minus 0, 1000. Rate will be 100. Okay. Now, after the first issue of 5 units, closing balance will be 5 units because 10 minus 5 at the rate of 100 and 1000. Then you again make a purchase on 14th of January. Inward is 20 units at the rate of 120. Amount is 2400. Your closing balance will be 5 at 100, which is 1000, and 20 at 90, which is
5
1800.
at 100 wouldn't it be 500, sir?
Sorry.
5 into 100, 500, sir.
Oh, thank you. So the value of inventory will be 2,300. Okay. Now on 31st of January of 22, when there is a sale of 10 units, at what rate will we issue those 10 units?
So the first rate.
First five,
100.
first five.
First five. First five at
100, sir.
100. Then next five at
90, sir.
90.
Sorry,
So
120.
So basically this 5 minus this 5 will be 0. So this will, nothing will be left here. And here we'll have 15 at 90, which is 1350. This is 5 into 100, 500 and 5 into 90, 450. Are you clear with the FIFO method?
Yes, sir.
Yes. Now, the sum of this 1450, what is this called? The sum of all
Cost of
outputs,
goods
what
sold.
is it called?
Cost of goods sold.
Can you be thoda louder, slightly louder?
Cost of goods sold.
Cost of goods sold.
Sold.
Everyone knows about this?
Yes, sir.
Okay. This is the purchases. And this is the 1350 is what?
So the rate we have
Rate.
entered differently, I think, so we have here
Sorry?
inwards we have written 120, sir, rate, and we have outward we have 90.
Okay, so this inward has to be 90, no?
Yes, sir.
Okay. So what is this 1350?
Inventory,
Inventory.
closing inventory.
Do you remember the golden formula what I had given to you when we did NPO?
Opening stock plus purchases minus closing
Opening
stock is
stock
equal
plus
to
purchases minus closing stock
is
is
equal to
equal
cost of
to
goods
goods
sold.
sold.
yes, right? Opening stock is 0 plus 2,800 minus 1450. So if I just calculate this comes to 1350. So basically you can see this 1350 is the same as the inventory value here. Okay. Now same thing we will do with LIFO method.
Sir, will they ask LIFO method like in exams?
They may ask.
They may.
See, even if it is not allowed by the standard, they may ask. Otherwise, they would have not given in the material also, no? But in, for example, in US GAAP and all, that is allowed. Only in IFRS and Indian Accounting Standard, it is not allowed.
Okay, sir.
Now, when it comes to LIFO method, first entry no change, second entry no change, third entry is a purchase. Now here also no change. Mihir, please don't annotate on the screen. It is difficult for me to write them. What will happen on 31st of January? You have to tell me here.
So entire 10 will be at 90 rupees.
Entire 10 units will be at 90. Very good. And nothing from here. And your closing inventory will be 5 of this at 100, which is 500. And this will be 20 minus 10, 900. So your closing inventory will be 900 plus 500, 1400. Your cost of goods sold coincidentally is also 1400, and your total purchases is 2800. Simple.
Yes, sir.
Yes, sir.
Okay. Then we have the other method, which is the weighted average method. Now, in weighted average method, there are two kinds of methods which are tested in the examination. One is your running weighted average method or perpetual weighted average method. Other one is periodic weighted average method. If they don't mention anything in the question, you have to use the perpetual weighted average method. Are we clear?
Yes, sir.
Perpetual means after every entry, you will update the weighted average rate. So considering the same thing, units inwards amount is fine, no outward, so closing also no change. On 7th January, when there is an outward, this will also not change because this will not change the weighted average. Now, when you have a purchase here, 20 at 90 and 1800, your closing units, this will not be there. So you'll have 5 plus 20, 25, amount 1000, sorry, not 1000, it has to be 500, no? See, I was making errors, though it doesn't impact. So here it will be 500. So now 500 is with you. You have purchased additional 1800. So what will be the value here? 500 plus 1800, 2300. So what will be the average? 2300 divided by 25. 92 will be the average. This is called weighted average. Okay. Then when there is an outward happens at which rate?
So that 92.
92.
It will happen at the weighted average rate.
Average.
So outward will happen at weighted average rate. This will be at 92. And your closing will be also at weighted average rate, which is at 92. And it will be 25 minus 10 units, which is 15 units. Now here if you see, $2,800, 1420 and 1380. Okay, slight difference because we took a very small example. Now in sometimes the question may say weighted average in a periodic inventory system. In that case, what you have to do is you have to just take the inverse. Okay, do the total and find out a single raise. So this 93.33, this is in a periodic inventory system. But if they don't mention anything, you will have to update the weighted average rate after every issue. If these kind of questions come in the examination, I don't think any one of you would lose marks on this. I'm highly confident that you will be able to solve this kind of questions. Now, any doubts so far in broadly whatever we have covered?
No, sir.
Okay, this is a quick, see, it's a quick revision for these methods. Now, the critical part where students face difficulty is when there is a physical inventory. Now, what is the meaning of physical inventory? See, a lot of you are not exposed to business, but how many of you visit supermarkets and departmental stores? Almost everyone?
Yes, sir.
You go to malls, right? Shopping centers and all of that.
Yes, sir.
Has any one of you experienced, what do you call, stock taking? They are counting inventory or they are taking a sheet of paper and they are marking inventories. Have you experienced any one of you?
Yes, sir. Seen, sir.
Seen, no? So generally what happens is how much ever busy the store may be, how much ever busy the factory may be, every company, every organization, they would want to know what is the value of inventory, because inventory is very critical and a lot of losses happen if inventory is not monitored properly. Say for example, every day if the staff start taking home some goods from here, some eating items from there, okay, you will not realize that pilfer is small. You will say small amount, no sir, 100 rupees, 50 rupees, what is the impact? But over a period of time, it can become a cultural issue and it can result in huge losses in organization. So inventory taking happens in almost all the organizations. It is mandated by standards on auditing. The management also has to ensure that inventory is present, right? Records are maintained. So physical inventory is taken. Now, say for example, we are talking about some stores which operate almost throughout the year. Let us say you take the case of, let us say, a Shoppers Stop, or you take the case of, let us say, Reliance Trends or Chroma. Continuously throughout there they do business, okay, and financial year end is say 31st of March. On 31st of March, it may not be possible for us to carry out stock take in all the locations, because one, the shops will be open. Even if you shut the shop for 6 hours, there will be hundreds of locations. So what management does, or what companies do, is over a period of time they carry out inventory taking. So it is not necessary that they will carry out inventory taking on 31st of March. As per the convenience, let us say they do the inventory taking on 7th of April of 2022. but we need inventory as on 31st of March. But we take inventory as on 7th of April. Now, the type of questions that are asked in the examination from these kind of adjustment is, they will say, boss, we have taken inventory on 7th of April. Between 1st of April and 7th of April, we sold so much of item, we purchased so much of item, so much of sales return happened, this happened, that happened, all of that thing. You let us know what is the inventory on 31st of March. Okay, so for example, on this date, there are 100 units of inventory. When we physically verified, there are 100 units of inventory. In fact, I have taken inventory of, bookstores. I have taken inventory of, clubs. We actually taken inventory of half bottles of whiskey and all of that. We used to total and then, tell, okay, this is the inventory of, beverages which is available. So we had to estimate, take a bottle, and we used to ask him, okay, how much quantity of wine is there in this bottle? Because even for costlier wines, even 15 ml and 30 ml used to be a big thing. We have taken inventory. When I was in BPCL, I've taken inventory of oil. So we used to climb on the tanks and put the dip meter and then see, okay, this is the quantity of oil. Sometimes there is a dip meter outside also, that is also possible. So that also we used to do. Okay, I've taken inventory of lubricants, so that I've done. So it's an interesting thing. So let us say I counted 100 units of books, 100 books. Okay, and during this period between 1st of April to 7th of April, bought 10 books, sold 20 books. Now tell me, what is the count of inventory on 31st of March?
So 110.
What is the count of sorry? What is the count of inventory on 31st of March? Everyone, I want all of you to calculate.
110, sir.
110. Others? Others? So, kya?
110.
110. How? See, so the mathematical way to understand this is, say this is X. You bought 10. So plus 10 minus 20 is equal to 100. Okay, X plus 10 minus 20 is equal to 100. So X is equal to how much? This is minus 10. If you take it that side, X is equal to 110. Very simple. This is what will be asked in the examination. But sir, it is not so simple. No, they give so much of complexities. See, the complexity happens because we complicate the question. So now what we need to understand is, with this information, how do we go back to the previous period information? That is one thing. Second thing is, are they asking about inventory, physical inventory value account, or are they asking about value? That is very important. Are they asking value or are they asking count? That is what will decide whether, how should we value inventory. If they ask count, there will be a different approach. If they ask value, there will be a different approach. Okay. Now what I'll do is, let us see if there are any questions asked for inventory specifically. We will take that and we will have solve them. If any one of you have any specific question that you want me to solve on inventory, please let me know. I'll solve that as well. Okay. If not today, in the tomorrow's class, that is Friday, I will take that. So this work is done. Let me close this. This is also done. This is also not needed. Okay, so let us go one by one. See, this is a very simple question. Opening, purchase, issued, issued. Find the value of inventory if the company follows weighted average method. 4 marks directly in your pocket. Nothing to worry in this. Okay, I don't think there would be any other inventory question in this. No, that's it. Then let's see here. True and false question, simple one. You can attempt it. That's nothing complicated. This adjusted selling price I have not covered. I'll cover it separately. Then we'll do this. Is a simple one again. Nothing complicated here also. Okay, consignor, consignee. Okay, nothing here. Okay. This is one thing which I will do. This I'll do now. Here, it is not that we have taken inventory at a future date. They have given us value on 1st of April. They have given us value of purchases made, sales, manufacturing expenses, selling and distribution, administrative, and the value of inventory. At the time of value of inventory as on 31st March, a sum of 20,000 was written off on a particular item, which was originally purchased for 55 and was sold for 50. Except the above mentioned transaction, gross profit on during the year was 20 on this is 20%. Okay. In exams, if they miss it, just ensure it's 20% on sales. So based on that, we have to value inventory. Let us do this question and then we'll move to the other category of question. Question number 5. Okay. Now, the best way to solve this kind of question is to kind of prepare maybe a trading account that will help you. If someone is okay in preparing a tabular format, that is also perfectly fine. Okay. So we can do either ways. You can do using the trading method, or you can do based on the statement format also. Okay. So let's say trading account. Now here what has happened is, if you see, there are some abnormal items. Now what do we mean by abnormal items? Those items which are not sold at their normal gross profit rates. Those are sold at a lower gross profit rate. So if I prepare a trading account, I have to opening stock, normal, abnormal. Okay, normal, abnormal. Here the question says inventory is 3,50,000. In this 3,50,000, at the time of valuing inventory on 31st of March, 20,000 was written off on a particular item which was originally purchased for 55,000. Now tell me one thing, this item that I am talking about, what would have, or what is the value of this item as on 1st of April of 2019? This item on 31st of March, 20,000 was written off, which was purchased for 55. As on 31st of March, what is the value of inventory of this particular item?
55,000.
55,000 is the selling price. They have sold. Oh, sorry, 50,000 is the selling price. 55,000 is the purchase price. From the purchase price, 20,000 is written off. So what is the value of inventory of this particular item?
35,000.
See, you purchase something for 100. While valuing that inventory, you said, no, this is not worth 100. I'll write off 20 rupees. So 80 rupees is the value of inventory. So even here, it was purchased for 55. But we said 20,000 is not recoverable. We'll write off 20,000. So the value of inventory is 35,000. So here, normal, abnormal is 35,000. And out of 350, if abnormal is 35,000, then what is the normal? Normal is 350 minus 35, which is 3,15,000. Okay, this is the opening stock. Then what do we have? Purchases made during the year. Purchases is 12 lakhs. So we can say purchases. Then sales 1850. Now in this 1850 sales, 50,000 is for abnormal item. So abnormal 50, normal 18 lakhs. Okay. Then manufacturing expenses. Will manufacturing expense come in your trading account?
Yes, sir.
10,000. To selling, distribution, and
Sir, 1 lakh. 1 lakh.
Oh, sorry, 1 lakh. To selling, distribution and admin expense, will it come in your trading account?
No,
No,
sir.
sir.
It will not come in trading account. Then they said gross profit. Gross profit comes which side? This side or this credit side or debit side?
Debit, sir.
This side, right? So
Debit
gross
side.
profit. What does the question say? Gross profit is normally 20% on sales. So on normal items, whatever is the sales of that, it is 20%. That is 3,60,000. Okay, here it will be 50 minus 35, 15 minus 35, 15,000. So how much is balancing figure closing stock? You do the total here and you do the total here. The difference, that is 1,75,000, is your closing stock. Are we clear with this?
Yes, sir.
Now,
Yes, sir.
if you want to do in the statement format, what you can do is you can start with either sales or you can start with inventory, whatever you want to do. You can say, okay, sale of normal items. Okay, sale of normal items is 18 lakhs less cost of goods sold. Now here, please note, you have manufacturing expense as well. So your formula will be slightly changed to opening stock plus purchases plus direct expenses minus closing stock is equal to COGS. Okay. So we do not have cost of goods sold, right? So first we'll do less gross profit. How much is the gross profit? 20%. So gross profit is 3,60,000, right? So cost of goods sold is 180 minus 360, which gives you 14,40,000. Now you have opening stock of 3,15,000. You have purchases of 12 lakhs. You have manufacturing expenses of 1 lakh. Closing stock is how much? So using this formula, you can say closing stock is opening stock plus purchases plus manufacturing expenses. I'll do it this way, sorry. COGS minus opening stock plus purchases minus manufacturing expenses. So that will be 14,40,000 minus sum of all of these. Okay, you get 1,75,000. I put it opposite, huh? I gave a wrong sign.
Yes, sir.
I gave a wrong sign here. Just let me correct it. So you can use this also. Or what you can do is you can take opening inventory, add purchases, add manufacturing expenses, correct? Less COGS. Same thing. See, you write in the formula form, you write in the statement format, you do in the account format, everything is fine. Only thing that you need to remember or keep in mind is that whatever is the abnormal part, you have to exclude the abnormal part and do this calculation only for the normal part, right? Simple one, again 5 marks in your pocket. Okay, then here do we have anything on inventory? No question was asked on inventory. Nothing was asked on inventory. So we'll continue tomorrow. Tomorrow we'll work on this specific aspect what I was talking about, adjustments, where we need more clarity. And in the meanwhile, if you have any specific question, like Fatima had today, she had been actually asking for last 2 class to solve a particular question. If you have anything specific for me to solve, where you feel you're getting stuck or you're having a doubt, please feel free to write it to me, put it in the group or sub forum. I'll take it up and I'll solve it in the next class. Tomorrow we'll solve some questions on inventory. Then we'll move to the next topic, that is consignment accounting. One of the most feared question, I should say, in the examination, but nothing to worry. Even in consignment, we'll ensure we'll score at least 7 to 8 marks out of 10 marks. Okay, that should be in our pocket. Fine. Any questions? Let me know. Otherwise, I'll end the session. So no questions. So we'll wind up today. I hope the session was helpful. All of you should be on your top gear while preparation. And after tomorrow's session, after we finish consignment, then I'll take any specific topics you want me to take up. Then we'll talk about the strategy. Now, all of you, you should plan your revision in a way that, before the examination. So accounting is the first paper. Okay. So accounting, give 1 more day extra. Don't give just 1.5 days. So maybe give about 3 days to 4 days for accounting paper. Ensure that all other things are done by 20th or 21st. So that, 20th actually, not 21st also. 24th is your exams, right?
Yes, sir.
So
Yes, sir.
by 20th, all others should be done. Okay, 21st, 22nd, 23rd should be dedicated to accounting, right? And then, you should revise it well. The first paper should be the best paper, not because, I am teaching or, that is my favorite subject, because that will set the tone for remaining papers. Okay. And your target should be at least in 2 subjects, you have to score more than 60. You should have that target, then only it will be easier for you to get that aggregate marks, right? Chalo, thanks a lot. Thanks for your time. See you again tomorrow at 4 o'clock. If you have more the doubts you get to me, more will be your learning, better will be your learning, and it will help the other students also. Chalo, thanks a lot, guys. Bye.